is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Hey, hope everyone is having a good morning so far. Welcome to everyone joining us from live trading to Benzinga Live. We've got a packed, great show lined up for you guys this morning. We are going to welcome on Ryan Pannell back from Kaiju ETF Advisors. Excited to talk to Ryan more about AI and how AI is impacting Wall Street right now. It is the story of 2023. And then at 11:30, we will be talking to Tom Lee from Fundstrat, of course, contributor on CNBC. So excited to talk to Tom as well. Ryan and Tom, two great guests lined up. So please smash the like. I think let's just go ahead and get right into it. I see Ryan hanging out backstage. So let's give Ryan our very special Zinger Nation welcome. See what's going on with Kaiju. All right, Ryan, great to have you back on again. How are you doing this morning?
Good, Aaron. Thanks for having me back. How are you doing?
I am good. So let's hop right into it. I'm curious, tell me a little bit more about the overall philosophy of Kaiju and kind of what are you guys working toward?
Yeah, I mean, that's a question we get a lot, and I'm going to do my best not to give the same, bullshit answer that everybody gives. It's a new, innovative, fresh take on investment management or whatever. Like anybody who's got a quant or AI focused company in the last 10 years says the same thing. But, okay, fine. So what did we want to do? We wanted to bring I guess more bleeding edge technology into investment management. On the professional side, the institutional side, the adoption of new technologies is really slow. Like retail is way ahead of institutional in terms of new technology adoption. Like retail traders will jump into a new tool a lot faster. They'll vet it quicker, and the institutional side is stagnated, really. And so we wanted to work on that side, but we wanted to use these new technologies. So, I mean, we took I'm going to say fresh approach, even though I said I wasn't going to do that. We took a fresh approach, started about 10 years ago with this iteration of the company. And we've been global and completely virtual the whole time. So like before the pandemic and Zoom living made that normal, we were already doing that. And it gave us a cool advantage in that we could hire the best talent rather than the best talent in a specific location. So if we were based in New York or London or Madrid or Copenhagen or wherever, and we were looking for, best data sanitization team or big data scientists or, quant team, derivatives mathematicians, you'd be looking in that region. We're trying to find people that would move to that location. And being globally distributed, now we're 17 countries and 13 time zones. Wow. We can pick the best people wherever they are. So
that must make planning all hands on meetings kind of difficult.
We tend to break it up by teams and that works well. But when we do have like a global all hands, for some of us, wherever we are, I'm based in Geneva, it's like the middle of the night. So there's always a thank you at the end for the people who are on at 3:00 in the morning, that sort of thing. But it's still, it lets you have a diverse workforce, lets you choose from a huge talent pool, and people just make it work out,
Yeah, I mean, so, speaking of the team, I'm curious, how did you guys develop the AI and the machine learning algorithms that actually power the DIP ETF? If you want to kind of talk about just a brief overview of the DIP ETF in case there are people in the audience that weren't with us last week. But I'm curious, kind of what goes into that process of developing those algorithms, developing those AI technologies that power that ETF?
Yeah, sure. I guess the foundation are really data, right? I mean, I think people are unaware of how huge a role data play in the development of any AI technology and how much of an intermediate process there is. Like you buy data from Morningstar or, we buy ours from Morningstar, SIBO, ICE, SpiderRock, and a lot of it is just raw output. So, the first step is like we have a huge data sanitization team that combs through this and pulls out null fields, makes it more ingestible by our system. And that is an enormous part of what happens. Like at the beginning, before any of the cool algorithms, before we start, building a series of collaborative neural nets or any of this, any of these technologies or processes you might have heard of. It's about like cleaning up an insane amount of data, and then you ingest it, and then obviously, you're manipulating it, and the more granular the manipulation we find, the more accurate the output. So you have like these neural nets that control a single function. Like they're just trying to make one decision in one tiny little piece of criteria that we're evaluating. And so, for dip, what we're doing is we're trying to identify artificially oversold stocks. So, I say that all the time. What the hell does that mean, right? Like, what's an artificially oversold stock? It's not everything that just retraces. And I think that's where investors that like have had some success with buy the dip, but not consistent success stumble, is that they're misidentifying like what's a dip, what is artificially oversold, and why is that more reliable. So I came up with this analogy of like, you picture like a basketball floating in a swimming pool, right? And that's the stock at its generally accepted fair market value at any given time. You add water to the swimming pool, basketball goes up. You remove water from the swimming pool, basketball goes down. But wherever it sits on the water, that's its fair market value. Now, if I take my hand, I stuff the basketball underwater, it's artificially depressed under the surface of the water. It'll stay there so long as I keep my hand there. But the moment I let go of my hand, it's going to pop back to the surface. And so that's an artificially oversold condition. HFT predation on liquidity pockets and void, low float stocks, stocks that are big S&P component, but they don't tend to move during the day sometimes. Chipotle, ISRG, things like that, can get easily artificially oversold. Anything can. McDonald's can. So you're looking for this specific condition, and you have this collaborative collection of neural nets that are identifying the unique criteria that surrounds that condition. And then you buy it. Sometimes you buy it and someone lets water out of the pool and it doesn't bounce back up. It's not a crystal ball, but more often than not, we find, that it bounces up. And then there's the machine learning layer, which is, I like the most rewarding. My favorite part of the technology is that. And you look at like the last 2 months of DIP's performance, and that is machine learning on display, the best we could demonstrate. Like nobody's touching that. I'm not stepping in and making changes. And that is literally the machine self-evolving and just getting better at what it does. It's a cool thing to watch, like as a scientist.
Yeah, so basically, so it's as if like the neural nets and these, you have these data webs and all these different data points. And are they kind of like categorizing, okay, a Chipotle or a McDonald's, like this would be maybe certain stocks are better to buy the dip on than other ones?
Yeah, so there's a universe of stocks which are more predictable than others when it comes to these artificially oversold conditions. And so each one has its own neural net that is looking for those specific conditions. And then each one has a regime classification engine and forward-looking change detection engine attached to it. So classification is just trying to say, where do I think I am? Am I bull, bear, or neutral? And change detection is saying, based on what I'm seeing right now, what do I think is about to happen? What's the probability of a change? And it also can come back with, I don't know, which is the most interesting for us because it means it's literally never seen that before. And that's where maybe you don't enter that in that moment. And then those engines, like they operate on the higher levels as well, the sector level, the industry level, et cetera, which I'm sure you have read about, like global engines versus like discrete engines and, how they're working together. And there's a hierarchy in decision making. And ours is similar to that process.
Got it. So one thing that's, very, fascinating to me about Kaiju, and we talked about this last week, is you guys have been using AI in finance like for years. It's not something that, just because it's been hot for the last 6 months. How's it been? You mentioned the diverse workforce all around the globe. How is it balancing both finance and technology? Is it hard to kind of, do talent acquisition for both, find experts that know about technology and AI and also about the markets?
Yeah, talent acquisition is a challenge in this space anyway right now because, there's no professional education in artificial intelligence. There's like these little certifications that are popping up online here and there, but nobody gets an undergrad or grad degree in AI. I mean, our director of the program, he's got a degree or a graduate degree in machine learning from 1994. So yeah, fine, but it's a subset of like theoretical physics. So you're usually finding people who are using AI in conventional sciences. So in our example, for Kaiju, like none of us come from a finance background originally. I mean, yeah, fine. Years ago we made the transition but my background is largely in cryptography and some theoretical physics. And 30 years ago, I was in film and television. So, like most of us have made this, like large leap at some point back from one industry to another, in conventional sciences, in derivatives, mathematics, et cetera, and then kind of come into finance with hey, it's a cool technology. I wonder if I can apply it to this industry. So it brings a lot of diverse viewpoints, selecting your talent that way, but it's also challenging, right? You get the hottest new, groundbreaking AI PhD from the University of Zurich, and we bring him in house, and he like has no idea what short inventory is, like not a clue. I don't know what this is or how it works, so there's some trading education that takes place internally so that, everybody can mesh and you get a workable solution.
That's great. Well, Ryan, I know, I think this week we're going to try to introduce this new segment that we'll end with, we'll call it the Kaiju Kicker, something you can leave us with from the professional trading world. Like you said, you've made this transition into finance now many years ago. So I'm sure you have a number of different tidbits and things that you can leave our audience with. What do you got for us today?
Yeah, I've as we were talking last week, I thought it'd be nice to, on this show, instead of just babbling about, AI or Kaiju or whatever, to actually leave with some sort of actionable, tip, a tool, something that we use on the professional side that's just not generally talked about on the retail side. I mean, like a long time ago, before I was a professional equities trader, before I was a PM, before I was a fund manager, before I was here, like I started as a retail trader. And there was no Benzinga to help me out at the time, but like back then I was scouring the internet, such as it was then, and retail chat rooms for like just anything, like somebody tell me, how to do this job better. And it was a minefield of misinformation. You had some quality retail traders that were putting food on the table for many years. And then you had just like the blind leading the blind. It was hard to tell the difference. And not a lot has changed since then, actually. And on the professional side, I have no idea why, but we just don't tend to share these tips. It's either because you're too busy or you don't care, I guess. So I wanted to, try to change that. So here's the tip of the day. Please, for the love of Pete, if you're trading equities, stop using limit orders. If you're placing your trade using limit orders, you're going to blow yourself up in 3 different ways here. Like we don't use limit orders on the professional side. 1, you're in the trade immediately. Right. So if you have read the intraday action wrong and you get a whipsaw condition, it's too late for you to change your mind. 2, you're giving permission to your broker or to the market maker, if it's not going to get filled from broker inventory, to fill you anywhere in the MBBO or up to your limit. So your likelihood of getting a precise, decent fill is very low. And 3, because 99% of retail traders use limit orders, there always have been quantitative systems, and now there are AI systems that predate on your order flow. It's easy to identify that type of order flow. It's aggregated and sold for third party, and we will actually predate on that order flow in terms of optimizing our own entrances and exits. So if you want to do what a professional trader does, entering a stock, you use a buy stop limit order. So that is a buy stop. If you're long the stock, if you want to be long the stock, it's above the current market price. Say stock's $20, your buy stop's $20.25, and then a limit of, let's say, $20.38. We call it a bracket order, and it means that the stock has to move into your assumption. So you think this is going to go up, the stock has to move into your bracket. It reverses and goes the other way. You're good, right? You're out.
You were wrong, yeah, and you never got filled. And so, but then if you were, okay, I like that. And So basically, like, now you're saying they have AI algos out there, or quant, that essentially will say, okay, we know a bunch of retail traders are going to have a price to limit buy this here, and they're kind of trading around that knowledge.
Yeah, exactly. And with a bracket order, you are going to be filled in the price range that you find acceptable. So you can't get forced there unless there's a cascade of limits in a pocket in a low float stock that crushes into your bracket order. It's the same on the short side, sell stop limit order. Underneath, let the stock collapse into the bracket, get filled optimally, and then continue with whatever your trade plan is for that. But that's the order type that you want to use. It's very difficult for institutions to predate on that type of order, which is why we use it. So hopefully that's of some use.
That's super helpful. I've never even thought about that, considered that. I typically just do market orders because I want to get into a trade immediately, and then I'll do different stop. Someone's asking about how about a hard stop order types. I don't know exactly. I always get run on my stops. So I think that's just talking about having stop losses, I guess.
Yeah, I mean, the stop loss, obviously, for risk management is the other side of that. You make sure that you have a correctly constructed asymmetrical return on risk. Tip number 2, don't be a retail trader that's looking for 50 cents of upside, willing to tolerate $1.50 of downside. You literally would have to be right 75% of the time to just break even, right?
That's not going to happen. Yeah.
You got to trade the other way around. When you win, you win $3. When you lose $1. Then you got to be right almost never, and you're still going to be profitable. So the stop loss placement matters when you're.
What percentage of retail traders did you say used limit orders right now?
It's 99% of retail traders. I mean, active intraday traders. If you include retail investors, yeah, there's a lot of market orders thrown in there as well. As you said, they're just I don't really care about, fill price. I want to be in this, and I'm going to be in this for the next 6 months. So 5 cents here and there is not going to make a huge difference. But if you're intraday, if you're swing, then execution matters. Those few pennies here and there are going to add up at the end of the year.
Interesting. Well, now I have a new way of placing orders when I go out to trade. What was it called again? The buy stop
limit order, BSLO, buy stop limit order.
BSLO.
That's right. So buy stop above the current price, limit above that, create a bracket, catch it in the bracket. If it doesn't get there, don't move the bracket. That's done you a favor, right? It didn't make it. Your assumption was wrong. Move on to the next stock.
There you go. Well, I'm excited to try this out, Ryan. Always great to talk to you. We'll bring you back on next Tuesday to learn more about Kaiju and what you guys are doing. Have a great rest of your day. And thanks again for hopping on Benzinga Live.
Yeah, it's great talking to you as always.
Always. All right, guys, that was Ryan Pannell from Kaiju. I'm going to drop that link in the chat if you want to check out more. Kaiju has some really cool ETFs right now. The DIP ETF that's using AI to buy dips in stocks that, like Ryan talked about, they're being predetermined as, hey, this stock is pretty stable, so if it goes down 10% over this period of time, historically, this is going to go back. McDonald's, a Walmart, these things are staples, which to me, it's if you want an actively managed ETF, something that you don't have to be the one kind of managing this all the time, and you still want to be taking advantage of these discounts, buying these dips. This is a great way to do it. Again, the DIP ETF. Hit the link in the chat to learn more from Kaiju. Alrighty, guys. Quick rundown for the rest of the show. I've got my man Nick Brown hanging out backstage. I'll bring Nick on. We'll go through some of the top headlines of the day. We'll go through what the market's doing. S&P 500, NASDAQ. See what some of the top movers and losers of the day are. And then at 11:30, 10 minutes from now, we'll be talking to Fun Strats Tom Lee. You've probably seen him on CNBC before, but he's taking time out of his busy day to join us on Benzinga Live. So excited about that. Nick and I are going to be, little tandem tag team that interview. So if Nick's ready, if he gives me a little thumbs up, then without further ado, I'll give Nick our special Zinger Nation welcome, and we'll bring Nick on and see. He's making me look bad. I'm going to bring him. I need to get changed real quick before I bring Nick on. All right, give me a second. Nick, you're making me look bad, man. I forgot my tie at home.
Yeah, I know. I was debating whether to do this, but I said since we have Fun Strats Tom Lee, I got to pull out the best suit.
You have to. You have to. Well, give us for those who don't know, who is Tom Lee? You're the one who initiated this. And I'm gonna leave you full screen for 1 second. I'll be right back. Okay.
Okay. So yeah, Fun Strats Tom Lee. He is the founder of Fun Strat, and he's the head of research over there. And so you see him a lot on CNBC. And so literally, he's taking time out of his busy day to come chat with Aaron and I. We're going to talk inflation. We're going to talk about his S&P target because he's been very bullish. He started the year at like 47.50, I think. And so he's upped his target to, I believe, 48.50. And so we're going to get some insight from him on that. We're also going to talk about inflation, see where he thinks inflation is going to go. We have the Fed meeting tomorrow. We're going to get his thoughts on the Fed, on what he thinks for the hike. So we have a good hour planned, or good 10 minutes planned with Tom Lee, just to get his intakes and to talk about the NASDAQ, talk about the market, see what's going on. But we did get earnings today. I'll wait for Aaron to get back before I get into anything. Oh, he is back. So Aaron, I am
back.
All right, we're in earnings season, and so this morning was probably the busiest morning it has been, and will continue. We get Google, we get Microsoft tonight. But just some of the headlines that we've seen yesterday, we had Whirlpool report earnings. They did okay. So let me give you this, Aaron. So what we're seeing for earnings is if you do good, so if you do beat on the top and bottom line and you give good guidance, you're okay. But then we start to get in the mixing here. If you do okay on the EPS, okay on revenue, and you're giving some okay guidance, you're okay. But then we start to get into like RTX, or now known as Raytheon Technologies. They had a phenomenal quarter. They beat on the top and bottom line. They raised guidance. But then the stock today is down 8%. So you have to dig deeper in the release. And there's a specific quote in the release that basically says that their jets or their engines that they're going to be using over the long term, they're going to be needed inspecting, and this is going to be in September. They're already issuing this guidance, and they're going to have to look at these engines in September, and they're going to be expedited. They need quick review, and they're worried it's going to take some time. So like companies like Raytheon, that's why they're lower. But other than that, if you do good top and bottom line, you give good guidance, and overall you're in decent shape, you give good commentary, the stock is going to be higher. But it's going to be very interesting to see when the big cap names report tonight, what kind of commentary is in the release. If it has anything to do with AI, you're going to be signaled. I believe that stock will move higher, even if it does give good guidance. But if it misses, then we have some problems. So tonight is going to set the stage for big tech because we get Apple and Amazon next Tuesday. So from a week today, we get Apple and Amazon.
Yeah, and I mean, so you said Google and Microsoft are tonight, correct?
Yes, Google, Microsoft tonight, along with Snap, Visa. There's a lot of earnings tonight. The three I'm watching, actually four: Snap, Visa, Google, and Microsoft.
Yeah, I wonder, I mean, Jay Rice mentioned it in the chat too, beating doesn't mean they went up, but I'm seeing Raytheon actually down 14% right now, so getting absolutely crushed. I mean, that's a huge move for an $120 billion market cap company, a usually kind of a steady mover. I'm curious, I mean, I'm sure anyone who bought puts on that going into earnings is getting absolutely paid out, because I'd bet a lot of money that's well beyond whatever the expected. Oh yeah, some of these puts are up 30,000% today. They were 8 cents yesterday, going for $3.15 today. Wow. But
I was going to say, Aaron, Dennis Dick, one of the co-hosts of Pre-Market Prep, really nailed this one. And so instead of digging deeper in the release, he watched this earnings print come out, and basically it was one person that triggered the sell-off, that they just kept selling. And he went into a whole detailed explanation, a whole teaching lesson this morning on Pre-Market Prep. If you were there, I heard it. I was listening. And he basically said this was caused by one person, even though, again, Raytheon beat on the top and bottom line, raised their guidance. I mean, everything was everything good. The commentary was excellent. It was just one little key piece of evidence that people may be worried about with their engines. Basically, they have to review them. Then also this one person selling. You don't see that happen too often. So this is the one case that you do.
Yeah, and I mean, so this could be a sign, this earnings cycle, that, just during like the big market rally of the past 6 months, companies were putting out good, decent reports and ripping, and now some companies are putting out good, decent reports, maybe not amazing reports, and the stocks aren't ripping. So it could be a sign that things are kind of starting to run out of steam. I don't know. I think the big tech earnings will be a bigger indication of that. If I don't know, Nick, if you were following the markets as closely back then as you are now, but in the end of the bull cycle after COVID hit. So I want to say it was like November 2021 into 2022 when the S&P and Qs started to top out around there. All the major tech companies, Apple, Amazon, you name it, put out record quarters. I mean, they put out like their best, their highest revenue in a quarter ever. And basically every single one of them ended up trading down even after these record quarters. This was again, November 2021 into 2022. And that was kind of a sign at the time that, hey, even though these companies are putting out record quarters and smashing, their highest revenue of all time, maybe there was some guidance concerns at the time, but their stocks were getting crushed. And I remember thinking like, this is, you want to see stocks. You don't want to see stocks going down on good to decent reports, really. I mean, it's one thing if they're flat to down a little bit, but when they're getting crushed, like Raytheon's down 14%, definitely a little bit concerning. But I don't think, I think we'll have to get through these big tech earnings to know more.
It's really going to set the stage tonight, just because EPS and revenue for Microsoft, and I even think Google, but for Microsoft specifically, because that's the one I have up on my screen here, they're actually supposed to be, it's going to be a record quarter. It may not be a record quarter, but they're supposed to have some growth year over year. So EPS that's supposed to come in tonight is $2.50 or $2.55. That same time last year, I believe, was like $2.23 or $2.45. So like the EPS and revenue are growing, but we have a lot of concerns here. And these stocks have run up a lot. We saw in the pandemic, that's what drove the NASDAQ to a record, that these big cap names just kept going and going. And so now we've had Tesla and we've had Netflix both report last week. And we talked about this on this show, that they were both up 90%. They were up a lot year to date. And so they did a little bit of a pullback. And so that triggered a little bit of a 6%, 7% a day after their earnings report. But we're going to have to really watch big tech. I don't know the year-to-date percentages, but I'm guessing if they are up a lot, then we're probably going to see some pullback if there's just one little negative thing in the report. And yes, there's a lot of people that scan the report very quickly, that scan and read it thoroughly, saying, yes, this is a good quarter. But then there's some people that really nail in that report and pick out the pickiest things that could make this stock go, that could make these stocks sell off, that Google and Microsoft tonight. If we see that picky little bit, that's really going to set the stage hard for Amazon and Apple. And remember, the bar is set high here. So if they don't beat expectations, the bar is set very high.
I will say, I mean, I think if you're like me and you're more in the long term, like bullish camp, even if some of these earnings reactions aren't ideal, if you look at something like Netflix, I mean, Netflix's report wasn't great. They missed and the stock traded down. But if you go back to where we were at, a year ago, and Netflix had a bad report, it was down 20-30%. Now it's only down, 8-9%. So it seems like maybe, even if some of these stocks are running out of steam, they aren't as seen as overextended by the street as they were at some point, or the guidance and reports are seen to be a little bit better. But again, I think we're going to know a lot more this afternoon after Google, after Microsoft, and then and like you mentioned, we're going to be getting more Amazon, Apple, you name it, in the next coming weeks, as well as an FOMC decision tomorrow that pretty much, I think, a 25 basis point hike is all but priced in, and basically, it seems like that's the consensus that's going to happen. And then, but from there, I mean, we've got a lot of different news things to talk about this week. I do see Nick, Mr. Tom Lee, hanging out backstage. So when we see Tom give us a thumbs up or something that he's ready to go, we'll bring on Fun Strats Tom Lee for a few minutes, see what Tom's been watching, see what Tom's been looking at. Just going through the overall indices real quick, because it did look like we got a little bounce on the Qs. Qs are up a little bit more than 0.5%. Let me go ahead and share my Benzinga Pro real quick as we go through these indices, just because I know some of y'all out there are more visual. So we got Qs up about 0.5%, SPY up about 0.2%, so pretty flat day on the SPY. Then the Dow getting kind of dragged down by Raytheon and some of those other value stocks that are down today, but still in the green. I think the Dow's going for 12 green days in a row if it can manage to close in the green. So that puts it in some historic runs.
Yes, if it goes green today, that will be 12. And if it goes green tomorrow, that would be 13. I would have to go back, very back in the record books. Right now, we're sitting on 11 straight green days. That's the longest streak since February of 2017. But I got to go way back. You got to go way back because Bespoke Invest, Aaron, pointed out that this has only happened like 6 other times since World War II.
That Dow up 11 days in a row?
Yes, and
I mean, you got to take it as a good sign. Like, I know there's a lot of people out there that are still going to be perma bears and be bearish and say, oh my God, we can't go up every, the market's getting overextended here. But I mean, when the trend is your friend, if the Dow's up 11 days in a row, like, I'm not going to sit here and say, okay, today's the day it's going to go down. I'm going to see how long it can go up. But all right, let's give Tom Lee, our special Zinger Nation, welcome, bring him on and see what Mr. Lee has been watching. All right, a man that needs no introduction, Tom Lee, head of research at Fundstrat. Tom, how are you doing today?
Good. How are you guys doing?
Good.
Good. Well, first of all, thanks for joining us here on Benzinga Live. Know you're a busy man, so appreciate you taking 10 minutes out of your day to join us. Well, let's start. I mean, I know you've been someone who's been pretty bullish for a while, going back to, I think at the beginning of the year, your price target for the S&P was over 4,500 when a lot of people were more bearish. Are you still a bull? And if so, do you have any like updated S&P price targets? What's your outlook right now?
Yes. Apologies for the terrible connection. I'm actually in between meetings here in the city. Yeah, I'm still bullish. We raised our price target at the end of the second quarter for the full year to 48.25. So our view is the S&P is going to be making new all-time highs this year.
Got it. And what do you think, I mean, from here is going to drive that push higher? Is it that inflation's going to continue to fall, allowing the Fed to ease off on rate hikes? Is it, earnings? What do you think here is the positive catalyst that gets us to those new all-time highs?
It's a couple of things. One is I think inflationary pressures are easing, and that's important because that's really going to set the tone for how the Fed treats interest rate and monetary policy. So if inflation sort of weakens the way we expect it to, I think November won't have a hike. I mean, the July hike might be the last in the cycle. That's a big deal because once markets feel they have some visibility on easing financial conditions, right? Because as soon as the Fed stops raising, that's easing conditions. That's going to reprice mortgages. That's going to boost CEO confidence.
Looks like Mr. Lee's connection not great. Well, if we get Mr. Lee back, we'll continue to hear his thoughts. If not, Nick, I'll make sure we get Tom back on a day where he's not so in between meetings. But I'm sure I'll pop back in. I was
going to say, Aaron, to his point regarding the hikes here, this is the question because B of A points that out this week. Subramanian over B of A. What happens if they go? All right, so here we know that they're going to go tomorrow. Okay, we're getting Tom. It looks like we're getting Tom. So Tom, to my point here, if the Fed hikes tomorrow, we know that they're going to go 25. The question is, do they skip in September and hike in November, or do they hike in September and they're done in November? Is there going to be a difference there?
Oh, it looks like we got Tom in the stream audio only still. We might still be able to hear you, Tom. This might help the connection. Okay.
Well,
but
it's a good question, Aaron, because
it is. I think
this. Well, I think this last night with commodity prices, if they're going higher. WTI is going higher. Wheat continues to go higher. So now that means inflation could actually edge up because that's right there, straight inflation. Commodity prices going up.
I think the Fed wants to get to a spot where it knows it can stop cutting. And here we're going to pop Tom back on and just be done with cutting instead of having to go, stop and go. raising one, pausing, raising, cutting. I think they want to just get to the point, okay, now we can be done raising, probably hold it there for a little bit and then eventually maybe start cutting. But Tom, curious to know your thoughts. We had you drop out for a few seconds.
What do you say? Do they hike in September, pause in November, or is it vice versa, or does it not really matter?
I think the Fed's committed to at the moment, in every other meeting cadence. So September, the default should be a pause. It would be a negative surprise if we did a September hike. I think tomorrow the discussion's going to be
Looks like Tom's connection.
Hey, this is the life of New York City. This is the life of busy people.
Sorry, Nick. I'm just messaging Tom right now.
Well, I was going to say too, Aaron, what happens if inflation, does come back? What's the Fed going to do after they say we're done hiking? We're done. We threw it out the door. What happens if inflation takes a turn? I'll take the other side of this, because right now people are saying inflation's coming down. Yes, but I don't hear anybody taking the other side saying, all right, inflation could go back up. I alluded to that last night on Twitter with commodity prices going up. What happens if we do see in maybe not this piece, or not in this inflation report, but in the next one? What happens if inflation edges higher? What's that going to do there? That creates a lot of questions right there.
Yeah, I mean, I think right now, the Fed is and Powell, they're at a point where they're very close to being able to say, okay, we stamped out inflation, we did our job, and it's not going to err on the side of, okay, let's cut or let's pause before the job is done. I think it's going to err on the side of, okay, let's freaking make sure that inflation is completely, back to our target, especially because the backdrop of that, the labor market is so strong. So they could say, okay, we can afford to keep raising rates a little bit higher to bring down inflation, because we haven't seen this pain in the labor market yet, even though Powell was signaling that we would see this pain in the labor market going back to a few, his press conferences 3, 4, 5 months ago, was kind of saying basically, like, he wasn't outright saying it, but if you read between the lines, he was saying, hey, unemployment's going to go up because we're raising interest rates to deal with inflation. And actually that didn't happen. Like everyone thought it was going to happen and it didn't. So now, I think between the low unemployment rate and the lowering inflation rate, they're going to say, okay, we're close to getting this inflation thing under 2%. Let's keep going, baby. Let's keep going. Even if it means a slight uptick in unemployment, because that has been a lot stronger than expected. So that's my theory. I think I hope and pray that the Fed will be kind of data dependent and say, okay, let's raise 25 basis points here, wait a month, see what inflation's doing, and maybe not get ahead of itself. But honestly, and I was curious to ask Tom this, I think if you had to give a letter grade to the Fed for over the last couple of years, like people were ripping on the Fed from both sides. You had people ripping on the Fed when inflation was at 40-year highs, whenever this was last December, and say, okay, inflation's at 40-year highs. How could the Fed do this? Like, the Fed should have been raising rates a while ago, so inflation didn't get this high. Then you also had people like Professor Siegel from Wharton on CNBC saying, okay, now that the Fed's raising rates, they're going to drive us into a recession. So people were ripping on the Fed for not raising rates soon enough. People were ripping on the Fed for raising rates that could drive us into a recession. And either way,
where's the recession a year later?
Exactly. So it turns out the Fed has been, I think, navigated, like in hindsight, it was easy to rip on them at the time, but in hindsight has navigated this pretty well. And I think if you got to give them a letter grade, it's got to be like a A- to A or B+ at the very least, to me.
They have a very hard job over at the Fed. And I'm surprised Chair Powell, is still the Fed chair because of all the heat has been taken. But I allude to that too. I mean, he was getting attacked from both sides saying, you started way too early, you started way too late, and now how do you keep going? You should have stopped a long time ago, a few months ago. But the thing is, inflation is very sticky. And so last night, Aaron, I don't know if you saw, I don't know how active you are on Twitter anymore, given we have Threads. I don't know if you transitioned over to Threads, but I posted 2 B of A charts last night from Mike Zaccardi, a freelance writer, and it was from B of A, and they showed you can see clearly 2 differences between the US economy and Europe. Like Europe's inflation is still way out of control. It is still very sticky. And even the one consumer number is the US is like up here, and here's like Europe. It's like still declining. There's a difference between Europe and the Fed and here in the US. And I think it was CNBC Sarah Eisen, I think last month in Sintra, Portugal, she had a whole thing of Fed members. I think she had Andrew Bailey. I think she had Christine Lagarde. She had Fed Powell. She had Bank of Japan. And they all had like this panel. And basically, they try to allude, do you guys all talk? Like, do you guys try and work together to see how you contain inflation or what each economy is doing? Because I think it was Bank of England, I think last month, they surprised with I think it was a hike or no hike. They surprised compared to what expectations were.
Yeah. And Nick, so right now, I mean, can we go through what'd you say was tonight? Or not Amazon, Google and Microsoft?
Yes.
What did Microsoft do last? I mean, I know they talked a lot about AI last time. But I mean, like, what are the big storylines going into both earnings tonight?
Basically, that Microsoft has beaten EPS from analysts in each of the 3 last quarters, 9 out of the 10 last quarters overall, and the company has beaten revenue estimates from analysts in 8 of the last 10 quarters, but missed estimates in 2 of the last 4 quarters. This is per our Chris Catchy report. He put out this article this morning. So basically, let me give you the numbers of what we're supposed to expect tonight. Microsoft is supposed to come in with EPS of $2.55 and revenue 55.47 billion. That's according to data from Benzinga Pro. I believe those are Refinitiv estimates. So to give you some perspective of what happened last quarter, Microsoft reported EPS of $2.23 in the 4th quarter of last fiscal year and reported EPS of $2.45 in the most recently reported 3rd quarter. So right there, estimates have been going up, and EPS estimates say that they're almost near $3 a share. Now, revenue totaled $51.87 billion in the last year's 4th quarter, and 3rd quarter revenue totaled $52.86 billion in the most recently reported 3rd quarter. Right there, revenue is supposed to be up year over year, and that's something we're not seeing with a lot of companies. That earnings that expectations say that a lot of them year over year are going to be down. But B of A was out with a note this week saying week 2, 4% beat so far right now, that this is a good sign that earnings season may actually be good this quarter, not worse than a lot of people were anticipating.
Yeah, I mean, and that's again, like we've had these kind of different mixed signals. You had Netflix, you had Tesla, which both came out on the same night, I think Wednesday afternoon last week, and they both didn't do that well. Then you had Raytheon. So you have all these like different things, but I think like for most people, it's going to come down to these big name tech companies so far. I mean, Netflix and Tesla, like out of these FANG companies, kind of 0 for 2 there. So we'll see what happens tonight. Nick, any other top headlines throughout Wall Street? Otherwise, I think, we'll go ahead and wrap up in a few minutes here, and we'll get Tom back on someday soon.
Yeah, just basically, we have a lot of earnings. We're in full earnings season, and so we have big cap tech tonight, but you can head over to benzinga.com, the Twitter page. We have the earnings calendar posted. If you could throw that up right now, just to give our audience a perspective of what's to come this week, because this is the busiest week. But we have to remember we have Apple and Amazon next Tuesday, so we can't forget that. But we have a lot of oil companies, a lot of traveling companies this week, a lot of the sectors. I think it's like 160 some S&P companies reporting this week, and like 14 Dow components. So earnings season is in full swing. All right, there's the earnings calendar. Take a look. Tonight we have Microsoft, Alphabet, Visa, and Snap. Texas Instruments, that's also a good one to look at for supply chain issues, to see what they're looking at. Wednesday, we have Meta after the close. We have AT&T, Boeing, Thermo Fisher, Coca-Cola. Thursday, MasterCard, McDonald's, Comcast, Honeywell, Ford, T-Mobile, Roku, Intel. And Friday, Exxon, Mobil, P&G, Chevron, AstraZeneca. So, this week is not done yet, and it's not going to be done anytime soon. Plus, we have the Fed tomorrow. So there is a lot on investors and traders' plates, especially we'll have to see how the post-conference goes along with earnings. AB, I'm ready to just call it a week and say we're done here. But, that's not me. I'm going to push through it. We're going to push through it together.
Oh yeah, I mean I mean, Nick, these are the best weeks to be in this because there's so much to talk about. It's you have way more to talk about than on a day or when there's not a lot going on. Well,
I was going to say, look, when we come back Thursday, we have so much to talk about. We have Meta. We're going to probably touch on Microsoft and Google, AT&T. We have Honeywell, Comcast, McDonald's. We have the show's already planned for Thursday well in advance.
Let's do it. All right, Nick. Well, thanks again for hopping on it. Thanks for scheduling Tom Lee. I'm sorry again that the connection and stuff didn't work out, but we'll get that figured out soon and have him back on.
Yes,
Nick,
we'll definitely get him back on.
I'm sure we'll talk again throughout the rest of the day, but enjoy and chat soon.
Yes, thanks, AB, and have a good week and be prepared for a busy week.
Let's do it. All right, guys. Thanks for everyone for tuned in to Benzinga Live today. Please smash the like if you have not already and subscribe to the Benzinga channel. Follow us on TikTok. Follow us on Instagram, wherever you get your news. Peace and love, y'all. We'll be back on Thursday with more Benzinga Live. Till then, happy trading.